European stocks aren't just flirting with highs, they hit record closing levels across major indices like the STOXX 600 and broader Eurozone equity markets. According to EC3, the STOXX 600, a 600-company benchmark covering large, mid, and small caps across Europe, climbed to roughly 621 points on a closing basis, its highest ever. Another source confirms this rally, with basic resources and financials showing strength as corporate earnings improved and commodity volatility cooled. Here's the ruthless truth. Markets don't go straight up because everything is perfect. They climb because capital chases returns. That means money moves into assets where expected future cash flows look strong relative to risk, even if risks still exist. This recent break to all-time highs reflects easing fears over AI-related disruptions. Recent sell-offs driven by tech uncertainties have stabilized. Investors smelled opportunity and shifted back in. Stronger than expected corporate earnings, banks like UniCredit exceeding estimates and lifting guidance have a disproportionate impact on confidence. Investors rotating into beaten-down sectors like banks, resources, and defense, where valuation risk is seen as lower relative to expected returns. Easing fears over AI-related disruptions, recent sell-offs driven by tech uncertainties have stabilized. Investors smelled opportunity and shifted back in. Stronger than expected corporate earnings, banks like UniCredit exceeding estimates and lifting guidance have a disproportionate impact on confidence. Investors rotating into beaten-down sectors like banks, resources, and defense, where valuation risk is seen as lower relative to expected returns. Forget the headlines. Climb to record highs doesn't mean everything is perfect. It means capital is flowing because better returns are expected relative to alternative assets like bonds and cash. Record highs also kick off a self-reinforcing loop. Markets break records, headlines attract funds. More buying validates breakouts, technical investors pile in. Cross-border funds, Europe and Asia, pour capital as U.S. tech volatility dampens global returns. Markets break records, headlines attract funds. More buying validates breakouts, technical investors pile in. Cross-border funds, Europe and Asia, pour capital as U.S. tech volatility dampens global returns. If you're investing for wealth, you study this dynamic. You don't chase storytelling, you chase where institutional and retail capital flow with conviction. 2. The drivers behind the rally, fundamentals or psychology. Now let's get beneath the surface, because record levels don't just happen. They're driven by a combination of fundamentals and market psychology. A. Market psychology, fear then greed. Markets are emotional. When fears over AI eating profit margins caused a tech sell-off, that fear pushed prices lower. Then once fear peaked and data showed earnings weren't collapsing, buy the dip behavior kicked in. Money rotated back not because conditions are ideal, but because the perceived downside shrank relative to upside. Remember this. Fear drives prices down too far. Greed, or relief, drives prices back up, sometimes too far. Fear drives prices down too far. Greed, or relief, drives prices back up, sometimes too far. Investors are always selling something cheap and buying something more expensive until they realize they overpaid. B. Earnings, the real foundation. Yes, headlines talk about record highs, but the actual fuel is corporate earnings beats, not narrative hype. When banks, asset managers, and industrial stocks report better than expected numbers and future guidance, institutional capital commits and stays committed because future cash flows look brighter. For example, UniCredit's profit outlook improvement lifted not just its stock, but entire bank indices. 1. Basic resources and industrial firms rallied because commodity softness stabilized, removing a risk factor. 2. UniCredit's profit outlook improvement lifted not just its stock, but entire bank indices. 1. Basic resources and industrial firms rallied because commodity softness stabilized, removing a risk factor. 2. This is not a tech-only story. It's breadth across sectors, which is a healthier underpinning than when rallies are driven by just one sector. C. Macro backdrop and expectations. Central bank policies matter. European central banks' recent decisions to hold rates steady create an environment where equity yields look more attractive than bond yields. In other words, locked cash in low-yield bonds equals no growth, equities paying dividends plus earnings growth equals real return potential. That's why equities could set records even while macro risks remain. Brutal truth. The market doesn't care about political tension, inflation headlines, or tariff talk. It cares about returns and risk pricing. Everything else is chatter. What this means for you as an investor. You must turn headlines like European stocks hit record highs into money decisions. No fluff, no narrative distractions, just returns. Here's what the smartest investors do when they see this. A. Look for strength in breadth. A record high in an index matters only if multiple sectors contribute. That's exactly what's happening. Banks, resources, consumer sectors, industrials, all showing relative strength. Indexes go up on leadership. When leadership broadens, the rally has more fuel. B. Don't fear records, fear weakness. Markets breaking record highs don't mean sell everything. It means you should ask, are earnings growth sustainable? Is capital inflow increasing? Are sectors widening participation? Are earnings growth sustainable? Is capital inflow increasing? Are sectors widening participation? If the answers are yes, the rally is healthy. Wait, see. Prepare for pullbacks. Every rally has pullbacks. The fact record highs are being set does not eliminate risk. It changes the risk profile. Stocks near record highs often pull back before continuing up because profit-taking happens. But smart investors use pullbacks to add to positions in quality assets, not panic sell. D. Discipline beats hype. Record highs attract headlines. Disciplined investors want strong earnings growth, sector rotation into undervalued names, macro easing sit-ins like stable rates, strong earnings growth, sector rotation into undervalued names, macro easing sit-ins like stable rates. You don't chase hype, you allocate rationally. Interest rates, central banks, and the silent hand behind European record highs. Let me tell you something most people don't understand. Stocks don't rise because companies are doing great. Stocks rise because money has nowhere better to go. That's the uncomfortable truth. According to Reuters, a major force behind European stocks hitting record highs is the growing belief that central banks are nearing the end of aggressive tightening cycles. The European Central Bank has not rushed into further rate hikes, and that hesitation alone is enough to move billions in capital. Markets don't wait for confirmation, they front-run expectations. Here's the brutal mechanism at work. When interest rates are high, capital hides in bonds, fixed deposits, and cash equivalents. But once investors believe rates have peaked, even if cuts are months away, equities suddenly become more attractive. Why? Because future earnings are discounted less aggressively. That mathematically inflates stock valuations today. According to Reuters, traders are increasingly pricing in a scenario where borrowing costs stabilize before declining, improving outlooks for sectors like banks, industrials, and consumer discretionary companies. This is crucial. Banks benefit because stable rates protect margins. Industrials benefit because capital expenditure resumes. Consumers benefit because inflation pressure cools. Now, listen carefully. This rally is not driven by optimism. It's driven by relative advantage. European equities still trade at valuation discounts compared to U.S. markets. So global funds ask a simple question: why park money in expensive U.S. tech when Europe offers cheaper earnings with improving conditions? That's how capital migrates. Another silent factor? Currency dynamics. A relatively stable euro reduces volatility risk for international investors. According to Reuters, currency calm has encouraged overseas inflows into European assets, especially from Asia and parts of the Middle East looking for diversification. This is how record highs are built. Stable rates, predictable policy, valuation gaps, quiet confidence, not hype. Great investors don't wait for rate cuts. By the time cuts are announced, the money is already... Sector rotation. Why smart money isn't chasing headlines. Here's a lesson I learned the hard way early in my investing life. The biggest money is made not by chasing what's hot, but by rotating into what's about to matter. According to Reuters, European stocks didn't hit record highs because one superstar sector exploded. They rose because money rotated intelligently across sectors. Let's break it down. Banks and financials? Banks were ignored, doubted, and even hated not long ago. Now they're leading. Why? Because stable interest rates mean predictable net interest margins. According to Reuters, strong earnings from major European banks boosted confidence across the sector. Investors suddenly realized banks were printing cash quietly while everyone was distracted by tech drama. Industrials and defense? Europe is rearming. Infrastructure spending is real. Defense budgets are no longer theoretical. According to Reuters, industrial and defense stocks benefited from long-term government contracts and order visibility. That's the kind of revenue Wall Street loves: boring, steady, reliable. Commodity stocks bounced because volatility eased. According to Reuters, easing fears around global demand shocks allowed investors to re-enter mining and resource plays at reasonable valuations. These stocks don't need hype, they need stability. Consumer stocks, with inflation cooling, disposable income expectations improve. That's enough for capital to rotate back into selective consumer names. Not reckless optimism, calculated exposure. Here's the key lesson. This rally is broad-based, not speculative. Broad rallies last longer because if one sector cools, another carries the baton. That's why record highs formed without mania. Retail traders chase trends. Institutional money rotates. That's the difference between gambling and investing.
6 record highs don't mean the end. They mean the test begins.
Now comes the part most people get wrong. When markets hit record highs, amateurs panic. Should I sell? Is this the top? What if it crashes tomorrow? Let me be blunt. Record highs are not danger signals, weaknesses. According to Reuters, despite European markets hitting all-time closing highs, volatility remains contained. That matters. Explosive tops come with chaos, leverage, and irrational behavior. This market shows controlled confidence, not euphoria. But, and listen carefully, this is where discipline matters. At record highs, bad companies get punished faster. Earnings misses hurt more. Overvaluation stops being forgiven. Bad companies get punished faster. Earnings misses hurt more. Overvaluation stops being forgiven. This is where lazy investors get exposed. Smart investors do 3 things at this stage. 1. Tighten standards. Only companies with real earnings, pricing power, and balance sheet strength deserve capital. Hope stocks die here. 2. Expect pullbacks. Pullbacks are not crashes. According to Reuters, analysts expect periodic corrections as profit-taking sets in. That's healthy. Markets breathe in cycles. 3. Watch liquidity. As long as liquidity stays supportive and rate expectations don't reverse violently, the trend remains intact. Here's the brutal truth I'll leave you with. Markets don't collapse because they're expensive. They collapse because liquidity disappears or trust breaks. Right now, Europe has neither.
Risk scenarios, the real threats lurking behind European record highs.
Listen, record highs don't protect you. They invite complacency, and complacency is what wipes out traders and investors alike. You've seen European stocks hit peaks, but every rally has a dark mirror, the risks that can wipe out gains in a heartbeat. Let's break down the biggest threats, like I'm teaching you to survive as an investor, not entertain you. Section A, geopolitical volatility, not just a footnote. Markets can rise on fundamentals, but they fall on fear. We've already seen how a sudden geopolitical flare-up, like tariff threats or conflicts, can trigger sudden selling in equities globally. In January, a sell-off across Europe and Wall Street happened when political tensions pushed yields and risk aversion higher, even briefly. That's your first risk. Politics isn't priced in until it explodes. You can have solid earnings, strong economic data, and still get blindsided by a geopolitical event. Trade wars, sanctions, energy embargoes, regional conflicts, they disrupt supply chains, bump up inflation, choke liquidity, and force risk assets down like a sack of bricks. This is where the narrative breaks. Markets are forward-looking until they suddenly aren't. Section B, market volatility and rapid shifts in sentiment. Even right now, stocks are climbing, but underneath that, volatility is far from silent. Tech sell-offs tied to AI fears rippled through European and global markets, showing how fast sentiment can flip from bullish to defensive. Volatility is the hidden predator. When fear spikes, correlations across assets jump toward one. That means diversification stops working exactly when you need it most. Section C, structural weaknesses, corporate debt and leverage. Here's something the headlines don't want you thinking about: the corporate debt bubble. Across the developed world, including major European economies, corporate debt levels have climbed to precarious territory. When credit conditions tighten, defaults spike, lending contracts, and markets get clobbered. This isn't theory, it's structural risk. Debt doesn't just sit there, it amplifies downturns. Banks get hit, pension funds get hit, retail investors get hit, it cascades. Section D, economic data can shift overnight. One session of weak economic indicators, weaker PMIs, poorer consumer sentiment, inflation surprises, and markets that once looked bulletproof can wobble. European stocks once paused as investors weighed macro news and geopolitical developments. Markets don't crash from perfection, they crash from disappointment relative to expectations. Section E, psychological risk, overvaluation and euphoria. This is the silent killer.
When markets hit records, valuations expand, and so does greed. Investors assume it's different this time. That's usually when risk models fail. Bullish momentum begets more bullish inflows, until one catalyst, even minor, triggers a reevaluation, and then all that capital rushes for the exit.
8 black swan events, the unpredictable catastrophes that crush markets.
If risk scenarios are probable trouble, black swans are the unimaginable that actually happens. According to financial theory, a black swan is an event that's extremely unlikely but has massive consequences, the kind you don't price into models because you assume it will never happen. Here's the brutal investor truth. The markets that climb the highest are often the ones most vulnerable to black swans. A. Black swans defined. A black swan event is rare, unpredictable, catastrophically impactful, only obvious after it happened. Rare, unpredictable, catastrophically impactful, only obvious after it happened. That's the definition, not fear-mongering, fact. Risk models ignore these because they fall outside normal probabilities. Examples in history include the 2008 financial crisis, the dot-com bubble burst, and the COVID-19 pandemic shock, all blind spots for most investors until they occurred. 10. Dynamite. B. How a black swan crushes markets. Black swans don't gently clip markets, they explode them downward. Sudden liquidity drains, margin calls cascade, volatility spikes, risk assets become toxic overnight. No warning, no trend, just chaos. Here's how it unfolds. Confidence collapses, capital flees risk assets. Liquidity vanishes, no buyers at any price. Correlation spikes, everything falls together. Systems designed for calm fail, models that assume stability break. Confidence collapses, capital flees risk assets. Liquidity vanishes, no buyers at any price. Correlation spikes, everything falls together. Systems designed for calm fail, models that assume stability break. This is why black swans are so devastating. Normal risk management was never built for them. Earth. C. Potential black swan triggers for European markets. We can't predict black swans, that's the point, but we can think about categories that have triggered them historically. Major geopolitical conflict or escalation, breakdown of key credit markets, energy crises, sudden global recession trigger, wild technological disruptions. All of these, by definition, are unpredictable until they happen. 11. Major geopolitical conflict or escalation, breakdown of key credit markets, energy crises, sudden global recession trigger, wild technological disruptions. All of these, by definition, are unpredictable until they happen. 11. Shield. D. How to protect, real defense, not fantasy. Real investors don't ignore black swans, they prepare for survivability, not prediction. Black swan investors don't try to guess what will happen, they structure their portfolio so that when the unimaginable strikes, they survive and can capitalize. That means hedging tail risk with options, holding assets uncorrelated to equities, keeping dry powder, cash, ready, diversifying geographically and across asset classes, not over-leveraging, hedging tail risk with options, holding assets uncorrelated to equities, keeping dry powder, cash, ready, diversifying geographically and